Joining me now, Maleeha Bengali, founder MB Commodities Capital. Maleeha, thanks so much for joining me at the desk.
Thank you for having me here. It's a pleasure.
So we're talking commodities. I think a good place to start would be oil, because we are seeing an uptick in oil prices, trading above $61 right now. It seems like the U.S. sanctions on Russian oil could be contributing to that. How significant are those sanctions, and where can oil go from here?
That's a great question. So we think the market, we've been bearish for the last few years because there really hasn't been a shortage in oil. We just think the players have changed, right? The main contributors to OPEC has been Saudi Arabia, UAE, and I think what Trump is trying to do right now is to coerce Russia, but just means the barrels will be replaced by Saudi and UAE actually contributing rather than losing the barrels. The market gets a bit nervous. Oil is actually holding on $55 a barrel. It's very cheap right now. So there's a bit of nervousness because people are very short. Sentiment is very weak. We're going to the winter northern hemisphere, but there's no shortage. As we've seen, OPEC has been releasing about 3.5 barrels. They still have about 2.5 barrels to come to the market. So this is just changing the player and getting market share. But market's a bit nervous, and that's why oil is rallying.
But if there's no supply issue there, where do you think oil goes from here?
We think oil stays between 55 and 65. Once it gets to 65, over there we're going to see a lot more supply come to the market because the demand side of the equation has changed. Chinese demand, there's a lot more storage on water. Chinese inventories are quite full right now. So we're in that range. Below 55 gets a bit tricky because that's when US shale loses money. So there's a supply crunch below that, and then there's a demand crunch above 65. So it's really range bound. But like I said, I think for the last 3 or 5 years, Saudi Arabia completely got their oil demand numbers wrong. Demand's very weak, and they need demand to pick up for oil to go to 100. But you won't get that. There is no shortage of oil.
Okay, so range bound, but if it breaks out of the range, more likely to go below $55 or above $65?
That depends on the economic cycle. So if we are in a recession, which we think into next year things will get a bit tough, it could actually break below 55. Because the US economy right now is slowing down. We have the Fed cutting rates to stimulate, so the labor market, but we're not in a very sort of rosy economic scenario. We talk about stagflation. We can get into gold and silver later on. So if we have that scenario, we'll stay at the low end of the range. Now, if we get to a point where we get the roaring 2020s, then of course oil can go above. But we're not really forecasting that because looking at Europe, China, and all our demand indicators, we're right now on a softening economy as opposed to a re-accelerating economy.
And what points to that, aside from the data, in terms of the commodities market? Because commodities often lead, right? In
Absolutely.
terms of the economy. So if you just look at where oil is, and we will talk gold,
Right.
silver, where commodities are.
So I'm actually glad you asked that question because people look at equity bonds and dollar, and that's great, but commodity markets are physically led. That means today if either you have the barrels or you don't. If you do, the price can go to negative. If you don't, it goes to infinity. So they're very economically sensitive and very demand supply sensitive. So they sort of lead the market. Now oil, like I said, there's a bit of a glut, so prices are staying subdued. Copper has actually been staying quite flat to robust because there's a bit of a tight, right? In the market, there's a bit of a deficit. Now gold and silver is a massive physical shortage, so we're seeing prices rally. But looking at a broad-based quantitative factor model, we're not seeing an acceleration on the physical side from a host of, because we track every oil barrel and every gas flow, and our demand supply indicators are showing pockets of strength, but there's no intermediate re-accelerating strength. So we think the commodity markets have been spot on. The big sort of canary in the coal mine here is the Fed monetary policy. I think the Fed's cutting interest rates, which we think they should not. The economy is holding in 3.2% right now, but they're being forced to cut rates because of US interest expense, debt expense, to help the banks into lending rates. But there is no reason to cut. The labor market is softening, but you can argue the break-even rate of payroll growth is a lot lower in this new economy. So they are judging everything from the last 4 years, and the Fed's reacting, but they think they're being too preemptive, and that is why gold and silver is moving the way it is, because they are cutting rates in a market where inflation is sticky at 3.2%. It's the wrong time, because you're cutting right now when markets are at all-time high. So if they do, inflation will get even worse. And gold and silver got a whiff of this last month. Bitcoin as well.
Is that why you are kind of forecasting economic weakness next year, because as a result of the Fed cutting when they shouldn't?
So no, the weakness comes from Trump tariffs. Obviously Trump's trying to get more power and get some money off that. There's also just general U.S. economic slowdown. Mortgage rates are really high. The U.S. consumers are actually softening. Retail sales are holding up. There are a lot of economic factors at play after the last 2 years. We're seeing a bit of a slowdown, but it's robust. It's not slowing down. But there is weakness in the economy. You talk about AI and technology, but we're not really seeing everything's at peak margins right now. So when you have a softening economy, the labor market's imploding due to immigration policies and just general, AI being laying off staff. cutting the interest rates, because we have a very debt-ridden economy. We have $38 trillion debt right now, and interest expense is $1.2 trillion. So as interest rates hold up high, the debt is very expensive for the US to service, but the Fed can't cut that to lower the interest expense. So Trump is trying to obviously get other ways to pay for that debt, but you have this sort of chicken and egg scenario that if you cut rate, debt gets even worse. And there's all these theories about they need to inflate the debt away. So that's just the fact that you have a slowing economy, but it's not slowing enough to warrant a raise, because the Fed has a dual mandate. It's labor market versus inflation, but inflation is not at 2%, it's at 3.2%. So they need to be vigilant and wait for a couple of months, because the data being bad in August, September is not really that bad. So if they wait, it's better for them, but they're not waiting, and their bar to raise rates is a lot higher than the bar to cut rates. I think that's where the market sniffed it out.
So we got your economic forecasts out of the way, your oil forecast, but let's talk about gold, because we're seeing a bit of a rebound today, but gold had its worst day in some 12 years yesterday. Still pretty close to the highs though. So do you look at oil as at gold as more pain in store, or was that just a healthy bit of a pullback? And
it was a much needed pullback. Okay, so let's talk about gold.
Can it continue to charge higher, I think is the question.
So gold is up 60% this year. It was up like another 30% last year. The reason why the gold market is changed, for us, gold is a mixture of a commodity, a digital currency, a physical gold, a recession hedge, inflation hedge, and now since the Ukraine war, central banks around the world, especially India and China, are buying gold to diversify out of US bonds because they've gotten very nervous as to what happened to Russia. So there's a secular micro tailwind to gold, and also a macro with the Fed cutting rates. So gold, obviously, in the last $300-400 move, retail side chasing the move. People who've been very agnostic on gold have been chasing it. There's a lot of leverage. There's a lot of option activity. So, we got parabolic moves. Those people got flushed out yesterday because of the delta and the gamma hedging. But we don't think gold is actually coming down. It'll probably stay here and sideline, consolidate a bit. But if the Fed does what it is, and we see the economy the way we predict in terms of stagflation, it'll continue going higher. So we're not bearish. But yes, 10 to 15% pullbacks are completely normal in a market that's moved 60%.
Is that a buying opportunity?
So yes, we have been long. We've been pushing gold for a long time. Obviously, it's good to take some chips off the table and do it. But we'll probably see it going to 38, 3,900. There'll be a lot of demand coming in at those levels. So this flush out has been weak hands, but institutions are not selling out of gold. Silver is a very different matter. So, if you ask me what I prefer gold over silver. But now there are other sort of assets like Bitcoin. Bitcoin has been a big theme for a lot of people. So it's been actually lagging this year versus gold. So you can argue it's two sides of the same coin, which one has better value. But it's about risk management. They all say the same story, but there is a physical demand tailwind coming from central banks that really makes gold very appealing. So
which one has more value though?
Gold, of course.
Okay.
Bitcoin is not really digital gold. It doesn't really have a store of value, you can argue. Gold is actually a resource. If things, go crazy, it's real hard assets.
Okay.
Bitcoin is a speculative trade on the Fed cutting policy. We like Bitcoin, but you have to know, you be cognizant of the risks of what it is. And once you understand that, it's about risk management. And it's going to be a mature asset class, still quite, small as an asset class, but we see tremendous growth for Bitcoin as well, just a lot more volatility.
Sure. So just final takeaway then for investors as they think about adding commodities to their portfolio and also protecting themselves from what could be some more market volatility.
So, people are used to trading the 60-40, 60% equities and 40% bonds. If we view a stagflation scenario, inflation is going to kill bond returns and bonds have done nothing. Equities will be sort of choppy as we've seen this year. They're really a range bound, and next year is going to be a lot harder because I'm talking about earnings, margins, all that stuff, right? So where do you sort of get your growth? And inflation goes up, you've got to actually diversify into commodities. Now that gets tricky because commodities are very physical oriented, very opaque. So we recommended our clients to be allocated to precious metals as opposed to basic resources because they're less economically sensitive. So we like gold, we like silver, palladium, platinum, but our preference is gold because the other ones have worse deficits of demand supply balance, and a bit of Bitcoin. We won't really go into altcoins because it's very, very risky. So that's how we've been pushing it. Silver, I think we loved it a lot, but right now the last 10 to 15%, you have to understand there's the US, the COMEX, the LME, and the Shanghai. There was no physical silver in LME vaults. When you buy an ETF, you have to have it physically backed. And in a very short period of time, the banks couldn't buy enough physical, which is why silver went parabolic. But there's no shortage of silver also. And now what we're doing is getting a bunch of boats, putting silver on, sending it to the exchange, and lo and behold, the price fell, right? So these are games we do because that's we understand them. Retail is going, what happened? Why silver crashed? So we got to be careful with silver. It's quite speculative compared to the physical market. Gold is your best inflation hedge. And I think as a portfolio, an asset allocator, you've got to have some performance, allocation to gold rather than just the tech stocks.
All right, we will leave it there. Maleeha, thanks so much for breaking it all down for us.
Thank you very much.
That's Maleeha Bengali, founder, MB Commodities Capital.